Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today I'm going to go over some information on Twitter. I'm going to go back and look at the economic cycle. So we're going to look at some information that we currently have, look at the economic cycle, compare where we're at in that cycle, and perhaps what the strategy could be. I know when we were talking on the website, a lot of people had questions on strategies. And I'll kind of go into that during this clip here. So let's just look at the information that I'm posting on Twitter. Looks like over in Australia, uranium's up, so that's good. I do think uranium's a good spot to be looking at. It is down, and you buy things when they're down. You should have a strategy in place. What is it? What is a strategy? A strategy is something where you want portfolio allocation to certain sectors, irrespective of what they're doing at that time. So what people tend to do, and I'll just jump in here real quick, they tend to chase price performance. So if oil goes up, they want to swap their uranium stocks to oil. And then vice versa, if uranium goes up, they want to swap their oil stocks to uranium. And they say, well, oil's not going anywhere or uranium's not going anywhere. That's the wrong strategy. That does not work. You need to do opposite of that. If you're going to be successful, I'm not doing anything. I let oil run when it runs, and then I add to whatever's down, which is uranium. So I'm doing the exact opposite of what most other people are doing. I'm not chasing price. I'm actually chasing the things that are down with new money. I'm not selling anything. I'm not selling my oil to buy uranium when uranium's going up and oil's going down. That's the exact opposite of what you want to do. But a strategy is buying on dips, holding the rips, so to speak. As long as the market conditions are ripe for that continued outperformance of those sectors. So I would say most people are almost doing it backwards, from what I understand. Looking at some of this other stuff, we've got record high in nearly 60 years. This is the official German inflation rate, rocketing higher. And the inflation, that the way that they measure it, so inflation to me is nothing more than money coming into the system. Money coming into the system can get directed towards things that aren't shown in the inflation rate. They use consumer price index for inflation, but money can come into the system. It can come into the banking system, and then they can direct it towards stocks and bonds, which doesn't impact the CPI numbers. The inflation is still in the system. The money exists. It's just in other assets. When this all rotates back to the other assets in commodities, it shows up in inflation, and that's what we're getting. We're getting a rotation of that money back into commodities, which shows up in CPI, Consumer Price Index numbers. Now, they use the CPI to hide inflation. They hide it by understating and doing hedonic adjustments and substitutions and all sorts of stuff. It's just a way to manipulate numbers. They don't really care about what the inflation has on an impact to you or me or someone else. They're just there to manipulate numbers to do whatever they want, in my opinion. We've got inflation versus quarterly bonds, which are getting smoked. We've got why are they surprised? Don't you follow you on Twitter? Inventories are falling while refiners run at near 100% capacity. So this is our inventory for transport fuels declining. And this is our refining capacity, which is very close to 100%. The margins are massive now for refining. There's massive margins on refining. That's who's making all the money. And another thing tied in with your strategy, if you're trying to create a strategy, is you have to find out where the margins are increasing. A mining company isn't a bet on rising prices of. It's not a bet on just rising prices of whatever they sell. You're betting on the margins expanding, and sometimes that's a really difficult bet to get right because the input costs are going up, fuel, labor, all of those things. And the metal price may not go up at the same pace as their input costs. Their margins are actually getting squeezed in an increasing metal environment. So the bet isn't that prices of the metals go up. The bet is that their margins increase for a lot of these mining companies, and that's where it's difficult to get right sometimes, because the metals can go up, but your input costs are going up faster than the metal. Their margins are actually decreasing for some of the companies, not all. So looking at, and remember, keep that as a strategy. Maybe royalty companies are a better bet than the actual mining companies if you don't want to deal with the margin compression and expansion. Coming on down, this is over $8 per gallon in Los Angeles. It looks like some people were seeing that. That's getting up there. That is getting up there. I can remember gathering around a single television as a kid. So energy poor Japan is going 40 years backwards with 17 nuclear power plants waiting to be restarted. Something has to give. I agree. Again, record inflation in Germany. This one I thought makes a lot of sense. They last only 20 years. They're talking about solar panels. Makes me feel kind of weird about my solar panels on my roof now. Canada ships coal to China. China burns coal to generate power, uses that power to manufacture solar panels. Sends the solar panels to Canada on ships burning oil. In Canada, we install these solar panels and call it emissions-free electricity. Creative accounting at its best. Doomberg says currencies are derivatives of energy. I put my 2 cents in there. Here's the proof of that. It says currencies are debt. Debt is a future repayment. Future repayments come from a natural resource or a product which is derived from energy consumption. Hence, currencies are derivatives of energy, and that's the proof. I just wanted to state that in there. Secular gold bull market. This is the 2000 bull gains so far, 635%. This is 2000 onward. I believe the orange is a previous bull market, and this is the way that these two compare over time. So the 1970s, the yellow, the orange is the 2000s bull market. You can see what's potentially coming up in the future. That's what I think will happen. It's going to be something very similar in size and in movement. Looking at Kathy Wood says people are betting against us shorting innovation. It says they're not shorting innovation, they're shorting your ability to identify it. I just thought that was funny. Very, very funny. And yes, I agree with that. Much of the gasoline price spike is attributed to the increase in crack spread, which indicates refining margins, not oil price. As these margins revert to historical levels, gasoline prices could subside while oil prices rise. Refiners would be highly profitable at $25 spread. So what this is telling us here on this crack spread is that the refining margins, the gasoline price, has a huge margin in it between gasoline and oil. So the margins for refiners have gone ballistic. It's almost at $50 per barrel. What could happen in the future is that the refining margins could come back down and the price of oil go back up and the gasoline price stay steady. So I think that the oil prices are actually a better spot to be than the refiners. Refining's already at all-time highs. I don't think they're going to go up much more from where we are today. I don't think the refining business would be the spot where I'd want to be right now. It'd be in oil, not gasoline. Looking at 1980s, Paul Volcker aggressively raised interest rates to tame U.S. inflation. I am actually in the other camp saying that he didn't actually break inflation. The demographic ran out, in my opinion. And then the demographic changed and we had low inflation. So he didn't break inflation. The demographic actually broke inflation. I posted this here so I could talk about it. Inflation's rising again because of the demographic. And interest rates will go up so long that the inflation remains high from that demographic. The demographic and immigration coming into the United States with a housing shortage, my guess will last till 2026 to 2028, somewhere in that range. So I don't think interest rates will necessarily stop the inflation. It may slow it down. I don't think it will stop it based off of where we are in the demographics and the shortage of housing. Will the market slow down in terms of house price increases? Yes. At some point it will. And we're already in the middle of that kind of explosive growth phase. It will slow down and then it will stop and then it will turn. The problem is we're just not in that turning phase yet. We still have a ways to go because of the housing shortages. Here's one. XLE is getting close to all-time highs, whereas XOP, that's where I'm at, which represents a broader energy market with 63 holdings, is not even back to 2018 highs. And it will rocket higher. I'm in XOP because it offers more leverage than XLE. XLE is more of the bigger companies. XOP has a bunch of smaller ones. The smaller ones are going to provide greater leverage. If you want a small cap energy, I can't remember the name of it, but someone brought it up during the Finding Value question and answer website session. It's in that video. That chart looks absolutely incredible for an ETF. Looks really, really good. So that's one that I would definitely be looking at. It's a small cap ETF for oil and natural gas. This is U.S. households' net worth as share of disposable income. It is rapidly increasing. So they're actually getting richer. So U.S. household net worth is going up, not down. But remember, it's basically just inflation. So the debts are being inflated away, and your net worth or household net worth is going up. That is why I have a fixed rate 30-year mortgage at a very low interest rate, and my worth is going up over time in relationship to my debt. It is being inflated away. That's why I'm doing it. Oil inventories are running low. Remember about those crack spreads in gasoline. Gasoline can remain flat. Oil prices are going to go higher. That's kind of what I'm thinking is going to happen. And the spreads will shrink over time. This is the decline in stock markets, and these are the rotation of money into gold. So this is the interest rates go from 4 to 21%. The decline in S&P 500, and this is the increase in gold price. NASDAQ bubble pop, and this is the increase in gold price. We had these down periods where the demographic didn't support higher things, and then it says the everything bubble pop and rising interest rates going down, and then gold prices will most likely head higher. So that's exactly what I think. This is what history is. This is what it's showing us. Your strategies, in my opinion, if I were to look at it, I'll explain my strategy, not your, but mine. This is where you position into commodities, hold on to commodities and precious metals. And right now, I think precious metals is a really good spot to be looking to add into, and the interest has really declined in it. So I'm going to add more. I'm going to continue to add more into it. In terms of like royalty companies and physical precious metals. Physical precious metals by far has the least risk way to play this precious metals bull market. You're out of the system as well. So I think there's a huge, at least in my opinion, a huge portfolio allocation to physical metals because of the risk and because of the direct nature of playing the metal. You're not playing margins in a company. Royalty companies, you're playing just price and volume, which is much preferable, and that's where I'm at. But physical metals and royalty companies are the spot that I like to be. It says, yep, just wait till everyone figures out OPEC Plus is out of spare capacity. Then the oil price is going to go vertical, guys. It's here's another thing. Investors are focusing on oil and gas, but Europe is facing a second electricity shock. Electricity is going up. My statement here is renewables have been putting in place in Germany, and look what is happening to their electricity prices. What this is basically telling us is that renewables do not lower the price of electricity. They could very well be 2 or 3 or 4 cents per megawatt hour. Problem is they are subject to commodity prices. They're subject to low efficiencies. They're subject to unreliable electricity power generation and gathering. They're also subject to no storage of electricity because we haven't developed that yet, or we may never develop it. So this is basically telling us that renewables don't work. This is the proof in the pudding. This is the actual data. This is the facts. You can slap these people around in the face with facts, and apparently they don't wake up. But without electricity storage, I don't know how they're going to solve this problem by putting in more renewables. It's just going to make the problem worse, and this is your proof of it becoming worse. So I think that the solution with the highest energy returns and the lowest mineral density is nuclear power. And there's some ways that we're playing it on the website with direct, small modular reactors, with uranium and some of the companies. I just think that that's where we're going to naturally progress towards, because it's a superior fuel generation source with storage baked into the uranium itself. There's natural storage with storing natural gas, oil, and uranium. That natural gas storage is superior because we don't know how to store electricity, and these guys can't store electricity. So this is what happens to your power prices when you do this. You get these shocks, and this is going to be highly inflationary, as electricity is a huge feedstock for everything that you build and consume. So I don't understand how this is going to work its way out by putting more of that very thing in. So I'm taking the short of it. Okay, so we got WTI was over 115 a barrel 15 hours ago. That's Sunday evening market. I didn't see what it is today. We've got excess cash per household. Yeah, obviously it's pretty bad for those that don't make a lot of money, but it's not too bad for those that make more money. Looking at platinum bullion. It looks like the inventories are continuing to decline in the NYMEX depository warehouse. This is platinum stockpiles. We're coming on down, and if this continues lower, I think we could very well eat through all the inventory. And I've been holding platinum. Platinum is my favorite metal. I think that is something that I will continue to accumulate when the price is low, very much like it is right now. I think we are going to see far higher prices, and that the ratios will return to more normal levels and probably go to overvalued levels in the future, in the next 8, maybe 5, 6, 7, 8 years, somewhere in that range. The big four, storage, we are continuing to draw down crude with SPR, gasoline, distillate, and jet fuel. So we're coming into summer driving season. We are coming into flying season, and we're coming on down. So yeah, I think we're going to continue to have problems in that market, and they will be quite high. U.S. mortgage rates fall to 5.1% in the biggest drop since April of 2020. So it's a good thing for housing market as the mortgage rates fall. Crude oil breaking out in a big way. If we close above 115, it's game on for new all-time highs of 150, and that's what I was talking about. The last form of resistance going across horizontally is about 115. We got to close and stay above 115. I think we'll probably have the next leg up. Here's uranium versus natural gas. Where uranium starts to outperform natural gas, net gas has been on a tear lately. I think uranium is about to make a big move higher. This is the ratio of uranium to natural gas. We are very low right now. We are in that support band, and that support band will probably reverse us and move us on up. So, in my opinion, and I said this on the platinum membership call as well, that I prefer uranium right now over a lot of the other areas. And people are looking to move uranium investments into natural gas or oil. I'm actually buying and adding into uranium, not reducing my stake. So that's what I've got for today, guys. Just sharing some information on Twitter, giving my opinions on it. I'm still very much a huge bull. I'll do another video on the economic cycle and give an update on that instead of doing it in this one because it's getting kind of long. So obviously, give me a thumb up for the content, subscribe to the channel, and if you guys want to, you can subscribe to the Platinum membership. In the description link below is the website. You can join there, sign up, and ride the bull market up with me and everyone else on the website and channel. So that's what I've got. Well, we'll catch you next time. This is Finding Value.